We've built the framework, studied the techniques, and examined the defenses. Now, it's time to see what happens when theory collides with audacious reality. When the safeguards fail, the compliance reports gather dust, and the sheer scale of illicit finance becomes a headline that shakes the global financial system to its core. Money laundering isn't an abstract concept practiced by fictional drug lords in movies. It's a concrete force that has toppled governments, corrupted international banks, and stolen billions from citizens. To truly understand its power and the consequences of failure, we must look at the evidence left behind in the wreckage of history's biggest scandals. These are not just stories of crime, they are masterclasses in systemic breakdown and the corrupting influence of profit, and in the brave work of whistleblowers and journalists who connect the dots. Today, we're going to dissect four monumental case studies. We'll start in a small branch office in Estonia that became a portal for a tidal wave of Russian money. Then travel to Malaysia, where a sovereign wealth fund was turned into a personal piggy bank for a global kleptocratic network. From there we'll examine the law firm leak that exposed the hidden architecture of global secrecy, and finally we'll look at a major U.S. bank that literally let armored trucks full of cartel cash drive up to its doors. Each case reveals a different facet of the monster, and together, they paint a sobering picture of the challenge we face. Our first case is a staggering lesson in how a single, remote branch of a respected bank can become the epicenter of the world's largest money laundering scandal. This is the story of Danske Bank's Estonian branch. From 2007 to 2015, approximately 200 billion euros of non-resident money, primarily from Russia and other former Soviet states, flowed through this small operation. To put that in perspective, it's more than the entire GDP of Denmark during that period. How did it happen? After the 2008 financial crisis, Danske Bank acquired the troubled Finnish bank Sampo, which included its Estonian operations. That Estonian branch had a lucrative but high-risk business serving non-resident clients, essentially shell companies from places like Cyprus and the Seychelles, whose true owners were hidden. Despite clear warnings from an internal whistleblower as early as 2007, and multiple internal audits flagging the business as dangerously non-compliant, the branch's profits were too attractive. The money flowed in through thousands of accounts. The layering techniques were textbook, complex chains of transfers between these non-resident accounts, funneling money to offshore havens. The red flags were massive and ignored. Some accounts had more than 300 transactions per day. The branch's profit per employee was 20 times the bank's group average, a statistical impossibility for legitimate business. The compliance failure was total. A tiny, under-resourced team in Estonia was overseeing this monstrous flow, while senior management in Copenhagen turned a blind eye, seduced by the profits. The fallout was catastrophic. Danske Bank faced criminal investigations across multiple continents, its CEO was charged in Denmark, its reputation was obliterated, and it exited entire countries. The scandal proved that when a bank's culture prioritizes profit over principle, and when oversight is willfully weak, it can become a willing engine for illicit finance on an industrial scale. For our second case, we cross the globe to a scheme that intertwined high finance, Hollywood glamour, and the highest levels of government. This is the One Malaysia Development Berhad 1MDB scandal. Conceived as a Malaysian state investment fund to promote economic development, 1MDB was systematically looted of an estimated $4.5 billion by a network led by financier Jolo, with the alleged complicity of then Prime Minister Najib Razak and his associates. The mechanism was a combination of brazen theft and sophisticated financial engineering. Money was siphoned through a web of shell companies and diverted into luxury real estate, a super yacht, fine art, and even the funding of Hollywood films like The Wolf of Wall Street. The scandal exposed critical failures at the highest levels of international finance. Goldman Sachs, which raised $6.5 billion for 1MDB through bond issuances, earned astronomical fees exceeding $600 million. Key Goldman bankers allegedly ignored glaring red flags, bypassed internal compliance, and even participated in the theft. The money was then laundered through the U.S. financial system, with banks failing to ask basic questions about the source of funds for multi-million-dollar purchases. The fallout was global and ongoing. Goldman Sachs paid over $5 billion in global settlements and pled guilty to a corruption conspiracy. Malaysia recovered billions in assets. Najib Razak was convicted and imprisoned. Jolo remains a fugitive. The 1MDB case is the quintessential example of kleptocracy, state-led looting, and how Western financial institutions, lured by fees and relationships, can become the enablers of grand corruption. Washing the proceeds and integrating them into the legitimate global economy, our third case study isn't about a single bank or fund, but about the revelation of the entire hidden infrastructure. This is the Panama Papers. In 2016, an anonymous source leaked 11.5 million documents from the Panamanian law firm Mossack Fonseca to the International Consortium of Investigative Journalists, ICIJ. The files laid bare, in meticulous detail, how the firm created and managed over 200,000 offshore shell companies for clients worldwide. This wasn't evidence of specific laundering transactions, but of the tools that make laundering and tax evasion possible. The data revealed how world leaders, celebrities, and criminals used anonymous companies to hide wealth, evade sanctions, and obscure corruption. It showed the step-by-step process, how nominees were appointed as fake directors, how bearer shares were used, and how major banks routinely requested these structures for their clients. The compliance failure here was systemic and legal. Mossack Fonseca was, for the most part, operating within the laws of the secrecy jurisdictions it utilized. The scandal highlighted the fatal flaw in the global AML regime, the reliance on a system that legally obfuscates ownership. The fallout was a wave of political resignations, police investigations, and, most importantly, a global push for public beneficial ownership registries. The Panama Papers didn't expose a single laundering scheme. They exposed the blueprint, proving that the offshore secrecy industry was not a niche service but a pillar of the shadow financial system use. By the powerful to operate by a different set of rules. Our final case takes us to the heart of the mainstream U.S. banking system and its direct, physical facilitation of cartel violence. This is the Wachovia Bank scandal. In the mid-2000s, Wachovia, one of America's largest banks, systematically ignored anti-money laundering laws in its handling of Mexican correspondent banking relationships. Mexican currency exchange houses, or casas de cambio, used Wachovia accounts to move billions of dollars. The bank failed to conduct proper due diligence on these high-risk clients. The most shocking element was the physical cash. From 2004 to 2007, Wachovia allowed at least $373 billion in wire transfers from these casas de cambio, and facilitated the physical transport of billions in U.S. dollar cash from Mexico, cash that was literally flown in on planes or driven in armored trucks to Wachovia vaults, no questions asked. This cash was the proceeds of street-level drug sales in the U.S., collected and smuggled back to Mexico, and then placed into the banking system through the casas de cambio with Wachovia's tacit approval. Internal audits and compliance officers repeatedly warned of the extreme risk, but the business was profitable. When finally prosecuted in 2010, Wachovia received what was then a record penalty, a $160 million fine, and a deferred prosecution agreement. Crucially, no individual executives were charged. The bank was soon acquired by Wells Fargo. The lesson of Wachovia is stark and uncomfortable. A pillar of the established Western financial system can become the most efficient launderer for the world's most violent criminal organizations. And the consequences for the institution can be a manageable cost of doing business. It demonstrated the absurdity of too big to jail and showed how the war on drugs is funded through the very bank we trust.